Hi everyone, it's Alex here at SesStream Capital Research. Welcome to our Inner Circle weekly webinar. It's currently Monday the 10th of March, just after 4:15 Eastern for the benefit of the tape. Okay, so market continues to sell off, and obviously the key question is, are we now in a bear market? I don't mean by an arbitrary technical definition of 10% this or 20% that. I mean, are we in a market where the dominant direction is now down? How to know, and if so, what should we do about it? That's the key question on my mind, and I think it should be on most people's minds too. So I want to look at the equity indices, the S&P, the Nasdaq, the Dow. I'll look at what's happening with bonds. I'll look at what's happening with oil and volatility measures, and then we'll get into some single name stocks as well. But I can tell you that I have a very simple view on single name stocks, which is if they're below the 200-day moving average, then our assumption, I think, should be they're going to fall. If they're above the 200-day moving average and they hold that as support, then there's a good chance they can move up. But until that 200-day moving average is re-established, then there's likely to be a whole lot of simple algorithmic selling, which is to say, if below 200, sell or don't buy. So that would be my default starting point on any single name stock. Okay, before we get into it then, we'll do our disclaimer in a moment. And then as always, we'll switch the mics on. So any points, comments, questions, anything at all, either open a mic and shout into the system, or alternatively use the Q&A or the comments function here in the webinar platform. We can deal with it that way. Okay, so let's get a disclaimer on your screen right now. So as follows, this webinar is intended for US recipients only, and in particular is not directed at or intended for any UK recipients. Any information or analysis in the webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in the webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. SesStream Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stocks, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's data transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of SesStream Capital Research. SesStream Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so let's get our mics on. Okay, mics are on. Okay, let's start with some charts. Now, actually, I want to start with the 10-year, actually. Let me explain why. Okay, so the market reaction right now in equities, I think you can read one of two ways. It's either seasonal weakness, and if you look at any seasonal chart of the S&P or the Nasdaq, you'll see that a weak March isn't uncommon, and you'll see that even in pretty difficult March months over the years, you may get a reversal at the Q1 options expiry date, which this year is on the 21st. And you can see that in really, really terrible market environments. Q1 2009, the great financial crisis ended, and Q1 09. People didn't realize at the time, but it did. Big reversal at those lows around the option expiry date. The COVID crisis lows, March 2020, reversed then as well. So this could be nothing other than the ebbs and flows of normal seasonal selling, and we don't know, but that's a possibility. The other possibility, of course, is that it's a reaction to policy uncertainty with the new US administration. And as always, this isn't a political opinion service. One's political opinion is here or there. It doesn't matter. What does matter, I think, is certainty of policy, and any allocator of capital, be that a CEO or a board of a company that's committing capex, or any institutional investor committing capital, is always looking for some certainty of the environment. So that means foreign policy, it means economic policy, it means approach to rates, it means approach to the bond market. Investors of all kinds, capital allocators of all kinds, like stability. Of course they do, because that way you can plan. And so for all of us in all of our capacities, professional and personal, we all prefer to work in stable environments, stable backdrop policy environments where we have some view on what's going to happen next. And so I would say as a distanced observer that with this new administration, its policies taking shape in real time, that is causing uncertainty in markets, and you could point to that as a reason for the sell-off. We don't know, of course. We don't know whether this is just seasonal weakness or this is truly a policy response. We don't know. It's not really possible to say. Even if you got Steve Schwarzman in a corner and you asked him, he's unlikely to tell you. So we don't know. I think the question is, how do we plan for each scenario? Why I want to start by looking at the 10-year is because this administration has not said that it's going to look after equities. If you think back to the COVID, think back to the GFC, the General Financial Crisis, there was a huge concerted international movement to support stocks and bonds, but also stocks. Bonds were supported by the invention of QE, and stocks were supported by the intervention in the equities market by government and quasi-government organizations, large investors like Berkshire Hathaway, and so on and so forth. And so there was a international stabilization effort to support first bonds and then equities. In the COVID crisis lows, the same happened. So you had, first of all, intervention in the bond markets, and then the federal liquidity, the excess liquidity, a lot of that found its way into risk assets of all kinds because it created a surplus of liquidity amongst rich people. And what do rich people do when they have too much money? They put it in securities. They don't tend to leave it in the bank. They don't need to buy, more shelter or food or transport. They've got gold already. So they tend to put it into risk assets. And that's what happened with the COVID crisis. You also had very, very, very explicit commentary in February, March 2020 about stabilizing the equity markets. So again, this is no personal politics in this service. But what you had back then was you had the then Speaker of the House, Pelosi, going on CNN and saying, right, we've seen a big sell-off in the equities market. She referred explicitly to the S&P not go, and I quote, "We know it's not going to go lower now." The S&P was supported at 220 on the SPY, about 2200 on the SPX. Not coincidentally, that was roughly the level where it was when the then administration took hold of the White House. So there was an explicit strategy to support equities in 2009 and 2020. We don't have that now. What we have is an administration that's saying that they want to get the bond yield down. Why do they want to get the bond yield down? Simple. They want to refinance. The Treasury Secretary here is a highly experienced fund manager, extremely competent individual. And his mission, in his mind and probably others, is to refinance US national debt. How do you refinance debt? Well, you do two things if you're in a corporate environment. You cut costs so that you have more. If you walk around a buyout fund or a hedge fund, you'll see people refer to something called cash flow available for debt service. So you cut costs in a business and you therefore make more cash flow available for debt service. And so to any lender, you're providing more cushion, more risk insulation. And the other thing you do if you want to refinance is if you're a company, you wait for a benevolent rate environment. Now, if you're a company, you can't really influence the rate environment. You just probably don't refinance when rates are high, and you do refinance when rates get low. But if you're the US administration, you do have some influence, not direct drive, but some influence on the direction of rates, on the direction of the cost of money. It's not really just through the Fed. I mean, we've seen the Fed cut rates in September last year, and the bond yield promptly spiked. So the Fed can't really control the price of the 10-year. If anything, the opposite is true. Why is that? Well, because the bond market thought the Fed had cut too much too soon, and that inflation would be the result. Bonds don't like inflation because they're fixed income instruments and fixed principal instruments. And so bonds sold off after the Fed cut the funds rate, and bond yields moved up. So the Fed doesn't control the 10-year. It's more realistic to say the 10-year and also the 2 and the 20-year yields control Fed policy. So what the administration is trying to do here, and they've said it out loud to anyone who's listening, is the 10-year has to come down. That means the price of bonds is going to go up. Traded bonds, government bonds, is going to go up. Now, the 2-year and the 20-year are also affected. I'm using the 10-year as a proxy for everything, but it's a reasonable proxy for the other things. There's obviously variances between the terms, but the 10-year is a good proxy. So this administration is focused on getting the price of bonds up and the yield down. Why? Because if they create more cash flow available for debt service, and you can see them doing that with the extensive cuts to the federal budget. Again, like it, don't like it, approve it, don't approve it, doesn't matter. That's what they're doing. That's why they're doing it. And if the existing bonds are trading at a higher price and a lower yield, then when you issue new bonds to refinance the outstanding debt, those new bonds get issued at a lower price, i.e. a lower yield. Okay, and so the debt service burden on the country becomes lower, or lower than it would have been if you'd refinanced in a higher rate environment. And so if you look at the current economic policy as essentially a buyout of the federal government by an activist investor who is cutting costs to make more cash flow available for debt service, and who is doing everything they can to drive down the cost of debt so that they can refinance in a lower rate environment, then that explains the yield track here. So so far the yield is following, you can see, a reasonably standard 5-wave pattern down. I don't think the yield is going to spike higher, personally. I don't think we're going to see a big run-up inflation. I could be wrong, but I don't think inflation is going to run hot in any meaningful way. I think the yield's going to keep coming down. And I think the government bonds are going to keep going up. And I think we're going to see a slew of refinancing over the next year or two in a way that will give the federal government a bit more breathing room. So if you want to pick something that is in line with government policy, my own personal view, I've said it many times, and I'll be right or wrong, I don't know, but my own personal view is that's bonds right now. It's government bonds. It's not equities. Now, equities may also rise, okay? Because if the 10-year yield comes down and the cost of money, if you like, becomes lower, if the cost of leverage for funds becomes lower, if the availability of leverage for funds becomes more plentiful, then probably equities will rise. But that's a second order effect. You don't have a Fed put here. You don't have an administration that has avowedly said they're going to support stock prices. The only comment I've really heard from the administration was pretty early on when somebody asked the president and said, do you think that people should be buying stocks, working people should be buying stocks? And his comment was, well, we may not like them to because there can be dips. That's the only thing he said. He's also, given commentary as well as Treasury Secretary Bessent over the weekend about the possibility of a recession. Well, you don't say that if you want to talk the market up. So the most important curve chart to me right now is this. It's the 10-year yield. And if we look at TLT, which is the easiest way for most people to own government bonds, TLT is responding accordingly. So it put in a low. TLT is a mix of 20-plus year duration bonds, and it put in a low 14th of January down here, 84, peaked just over 1.618 wave 3 extension at 93 almost, sold off, put in a wave 4 low here last Thursday by the looks of it, and I think it's in a wave 5 up. Now, again, this is a projection, it can be wrong, but direction of travel, I think, is yields down, bonds up. And so personally, I think I'm right in saying probably my biggest exposure now is TLT, TMF, which is the levered equivalent of this, and some euro equivalents. So I put my money where my mouth is. I think this is the horse to ride at the moment. Equities, I think, are a second order issue. So if we look at what's going on with the S&P, so let's zoom out a bit. Hang on. Let's try again. So this is our longer term S&P chart. I mean, it just looks really ugly on the second. It just looks really ugly for March. From we're back to September. Okay, so that's 2 quarters lost basically. So that's not pretty. Now, if we look back in history, recent history, what do we see at the end of the 2021 bull market? We saw a top put in December, repeated in January, and then a deep sell-off. So by the end of February 2022, we were back to May 2021 levels. Is that right? Yeah, May 21 levels, so a deep sell-off. And then there was a relief rally in March, and March closed out back where February started, which was not very much below the all-time highs. Now, the easy conclusion there is to say, well, it's just a dip and off to the races now. That turned out to be wrong, as we all know, and we can see here before us. So my expectation with equities is that we do get some sort of rally in response to this. That's a very deep sell-off. You don't see these big red monthly candles very often. There's one here in January 22. There's another one here in April 22, June 22, and September 22. And that's about it. Nothing else is really that big. 3 months here, August 23 down to the October 23 low. It doesn't happen very often. So I would expect to see some sort of upturn. But I think my default assumption, until proven otherwise, because this is safer, is I think it's safer to assume that any rally is simply a relief rally. In other words, a move like March 2022, which is basically an opportunity that the market gives itself for any late sellers to get out not too far from the all-time highs. So that's my default expectation now. I might be wrong. It could be that this just turns around and rips to a new all-time high. That's very possible. But, again, we'll know if that happens because we'll see it in the price action. There's nothing in the March price action so far that suggests that's going to happen. This just looks like a heavy sell-off. We have to see if it turns itself around. But if, for me personally, I have some accounts where I was exceedingly cautious, and that's turned out, pretty well, where there's 2/3 cash and some bond funds, and that's it. And I have some accounts where I took more risk and they're down a bit more. And so my plan on the riskier accounts is, if we get a relief rally, probably just lighten up on the way back up and see what happens. And then, if it keeps moving and it keeps running up to an all-time high, then just I can always buy on the way up. And if it rolls over, well, then I can add shorts at a higher level to now. So for me, and I don't know if I'm right or wrong, obviously, my assumption would be I think we will get a bounce. I think the bounce, for me, I'll be treating it as a relief rally until proven otherwise, an opportunity to get out of longs at a level higher than now, reset shorts at a level higher than now. And if it turns into a run to all-time highs, well, then I should be adding on the way up. So that's my basic take on markets right now. Let's look at the NASDAQ. I mean, it's the same story as the S&P, really. In a minute, we'll zoom in and look at the moving averages, which tell a really clear story. So the NASDAQ is back to, again, the September lows of 2024. So, that's 2 quarters of value wiped out, and in pretty short order. Now, again, if you look at the NASDAQ, we've had 4 straight months of down now, and not just a bit down, but heavily down. And that doesn't happen very often. If we look back to 2022, I think is probably a reasonable comparison sort of year, which is it wasn't the end of the world, but it was a meaningful sell-off. The second quarter, so I'm sorry, this is a weekly chart. Second quarter saw 1, 2, 3, 4, 5, 6, 7 consecutive weeks down, and then Q3 saw 1, 2, 3, 1 up, 4, 5, 6, 8 weeks down and 2 weeks up in that 10-week period. So 4 weeks straight down like that is unusual. And again, I would probably expect some sort of bounce to come along. Key dates, again, we've got CPI, I think I'm right saying is this week. I think it's Wednesday. Check that, but I think it's Wednesday. And March 21 Q1 OPEX. So if we're going to get a reversal here, if it doesn't happen on or before the 21st of March, or the day after for re-hedging flows, then I think we're in a bear. So that's my back test here, which is if we get a reversal now, tomorrow, whenever. Okay, interesting. If CPI comes in at a level to which the market reacts bullishly, and that doesn't matter what the number is, it matters what the reaction is. Okay, interesting. But the backstop for me is Q1 options expiry, because you can imagine that investors ought to be very, 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 very overweight puts now, because you can see with the spike in the VIX that people, even at these, even after this big sell-off, people are still buying S&P 500 puts with greater than 30 days expiry. That's what the VIX tells you. So this tells you that people are still very worried, still adding protection, and that tells you that Q1 OPEX is likely to be very put heavy. And that's a perfect setup for a bullish reversal. So if we don't get one on the 21st of March or the day or two thereafter, that's a big tell. Let's look at the Dow. Dow, as always, more muted in its sell-off. We're back to the January lows in the Dow. That's all. So in the other indices, we're back to September. In the Dow, we're back to January. That's all. The Dow keeps trying to move up before the others. It tried today and failed. It keeps trying. So I think that if we get a reversal to the upside, we'll see it in the Dow first, I think. And finally, let's look at the Russell. Russell, the short-term chart's more interesting, actually. So let's look at these. Let's dive in a bit. Let's look at the S&P shorter term. Let's put the moving averages on. Someone asked, by the way, why use moving averages now? And the answer is because now they're relevant. If we just keep moving up, then who cares where the 200-day is? But now it's really relevant. So the S&P broke the 200-day on Friday. It rallied away from it and closed quite a way above it. Today, it broke through it and it just kept settling down. And okay, we hit a low of 555, closed at 560. Okay, but it's still below the 200. And so below the 200, my expectation is more down. To get bullish, you want to see SPY climb up and over the 200-day and keep moving up. Now you see that with moving averages, this happens. This lighter blue line is the 50-day, and you see that just because it's pierced doesn't mean it's gone forever. So this is April 24, sells down below the 50-day moving average, comes back up to it, hits it on a relief rally, rejects, bounces up, gaps up through it, and away we go. And then the next time it's retested here in May, it's support, and then we come into July, hits it as support, bounces, support again, breaks it, plunges down, gaps down through it, rips up through it, down and through it. So you can see that these moving averages are respected. Now, it's not a coincidence that happens. You have machines trade to this. Buy above the 50-day, sell below the 50-day. Buy above the 200, sell below the 200. And that's my point, which is if below the 200, you'll have a whole lot of programmatic selling until proven otherwise. So with any ETF, with any single stock name, doesn't matter what it is, doesn't matter what the other appeals of it might be, valuation, narrative, event, possibility, doesn't matter. If it's below the 200, my starting assumption personally would be the default direction is down until proven otherwise. So look at the QQQ. If you want to know why I sound so different from last week, by the way, it's very simple, which is, last Monday, we were above the 200s in all these indices, except the Russell, but the Russell is a different thing anyway. We're above the 200, and now we're below the 200. So here's the NASDAQ. I think it's fairly clear now this was a shallow wave 3, wave 4, wave 5 high, just about made a new all-time high there. I could see a situation in which the NASDAQ is pretty early in this correction, because I don't think this is an ABC yet. I think that's an A wave. And if we get a relief rally that can push back up to, let's say, the low 500s, that, to me, is probably a selling opportunity. And if that proves premature, then one can always add on the way back up. But you can imagine a scenario where we bottom around now, just because it's sold off so much. We get a relief rally back up and over the 200 that doesn't break the 50-day, which will be by then at around 515 or thereabouts, doesn't break the 50-day, and instead rolls over and sells back down below the 200. You can imagine that. If you want to know what an A equals C correction looks like, this is the Russell. Put in a perfect A equals C pattern, finished it today. This is the wave 5 high back in November. We get an A wave down here, bottoms out in 13th of January, B wave up, which will be looking at it a roughly 50%-ish retrace on that A wave-ish, and then a C wave down that hit today to the dollar, almost to the cent, hit the A equals C condition. In other words, the share price drop in the C wave is equal to the share price drop in the A wave and bounced. The Russell is way below the 200, way below the 50. You can see the 50 is now downward sloping. 200 is almost downward sloping. If the 50 crosses the 200, you'll see people refer to that as a death cross, which just tells you that there's likely more downside ahead. Again, if you look for green shoots anywhere, look in the Dow and the Russell. Sometimes the Russell leads the way up, and that's because it's highly volatile. So people are looking to deploy capital into a risk-on situation. They know the Russell is more volatile than the S&P. So if you want to make a quick buck, basically on a reversal, probably the Russell rallies faster than the S&P or the Nasdaq. The Dow also today closed at almost an A equals C, a bit below actually, and bounced. Now the Dow looks like it closed just over the 200-day. So if you're looking for any bullish data right now in equities, that's it. It's the fact that the Dow put in from this wave 3 high back in early December, put in an A, B, C move with an A equals C termination and a bounce and closed over the 200-day. That's your bullish argument. And the 200-day is clearly still upsloping in the Dow. So if you're looking for bullish data, that's the most bullish data in equities that I can find personally. Okay, before we do any single stock stuff, let's just finish off. We looked at volatility already. We looked at bonds. Let's finish off and look at oil. Oil is, I'm not sure what to make of oil, to be honest. Let's lose the moving averages for a minute. So this is West Texas futures down here at 65-ish. It's been a support level for quite some time, as you can see. We could drag that level back to here, and in fact to here. So you could say that oil might be at support. Why I can't really make sense of that is because by all accounts inflation looks to be coming down. Typically oil will move up if inflation is moving up. It'll move up as an inflation hedge. Sometimes it's the source of inflation. So can't quite square what's happening in oil right now. I'm pleased to see that even the world's best oil trader is having a pretty tough time at the moment. So I'm glad it's not just me that can't make sense of the charts. I claim to be no sort of oil expert, but oil looks unclear to me. It's not giving any particularly clear signals to me about the direction of equities personally. Okay, so let's do questions. We have JM, you're on.
It's Jake. I just wanted to ask about the QQQ. Hey, how are you?
Yeah, good,
Um,
thanks.
yeah, just looking at the QQQ in say the near term.
Yeah,
I wanted to get your view on what we might expect um, very near term. If we are at this A equals, this looks like
well,
this
I don't.
technical target where the bottom might be in, and we should
Yeah,
be seeing a retrace.
well, okay. So the trouble is um, I can see an A equals C termination in the Dow there, and I can see it particularly in the Russell. It's a really clear one in the Russell because the Dow, you've got this. I forget what it's exactly called, but you can see that the wave B high was almost at this wave 3 high, which you do see sometimes, but it's unusual. And so this is quite a weird connection. If you ask Fred Frog, I think he might call that a flat. He's better at this stuff than me. But in any event, the Russell, which is usually the weakest of the indices, has put in a really nice A equals C. And so it's possible from the fact that the Dow and the Russell often run up out of corrections first. It's possible that we get a move up. And so if we do, then yeah, I would expect the NASDAQ to run up. The trouble I have here is I don't see that this correction is done. Now, of course, we don't have to have A equals C corrections. They can form any pattern. Of course they can. But if you look at the flight of capital out of US tech, it's pretty rapid. And so yeah, this could run up to new all-time highs, but my guess is it's going to have a hell of a time doing that. So me personally, if we get a bounce now, then as it moves up, I'm probably going to be selling some Nasdaq. I've got some TQQQ that remains nicely in profit. I probably will be selling some of it on the way up, and then if it keeps going up, well, buy it on the way back up again. But I think I'll be looking for this as an opportunity if it runs back up to pocket some gains and then probably add some shorts higher. That's sort of my basic plan. Because absent, what is it that's going to change this story? Okay, CPI could change the story. Again, I think that's Wednesday. I have to check. Options expiry on the 21st could change the story, and Q1 earnings could change the story, but that's not for at least another month, 6 weeks. So I think the Nasdaq's the hardest one. It's way below the 200-day. It shot through it, didn't close above the 200-day on Friday, whereas I think I'm right in saying the S&P did. Actually, no, it didn't quite. It's the weakest of the indices. So that's the one I would worry most about personally.
Would you, I don't know if you can go over this now a little bit, let me know, but how would you gauge validation or invalidation on the timing of selling if we're trapped long and we want to get out?
Yeah. Okay. Well, usually you can do it with a simple retrace, right? Usually. So if you run, let's get rid of that for a minute. Let's just clean this chart up for a bit. Let's just get rid of that and 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 get rid of that. Okay. So let's say, for the sake of argument, that today's low is the A wave low, and it might be, because look at this, big red candle here, this big red volume bar here. In which case, it's common to see a retrace of 50% or 61.8%. It's uncommon, in my opinion, to see a B wave, come back that high. Like they can do. I mean, in theory, according to these patterns, you can see a B wave above the prior high. But if you look at the optimal, let's say, so if I look at my own holdings, I've got some Nasdaq holdings that are in the money. I fancy lightening up on them a bit, and so probably what I will be doing is thinking about selling in that sort of zone there. Why? Because that's a natural sort of, what's a B wave? It's a head fake, right? It's designed to do two things. One, if you're a grown up, but you miss selling at the highs, this is other grown ups giving you a chance to get out not too far below the highs, right? This is a big, it's a big gimme to second tier institutions, basically. If you weren't in on the joke up here, well, someone's giving you a second chance to get out. But it's also the most brilliant, psychological trick on any unsuspecting other investor who thinks, oh, well, yippee, that was just a sell-off and we're off to the races now. And so my assumption for now would be this is a sort of a sell zone between that, just below the 50% and probably no higher than 61.8. And then to me, let's say I sold, I don't know, half my Nasdaq holdings up here. If it keeps moving up, well, I don't mind buying again up here, and I can always put a stop lower. I can, hedge up here. I don't mind that. But I think it's forgivable to have missed the brutality of this sell-off because it's been, rapid. I think what's much harder to forgive, if you look yourself in the eye, is to miss the relief bounce. Now, I'll say that in 2022, I made this mistake, right? I thought, okay, it's sold off, it's corrected, we've got a bounce. There's general equity strength, earning strength. Yeah, I hear this rate rise stuff, but it hasn't really happened yet. And my mistake was I got caught in the downdraft in Q2. So my 2022 was okay in Q1, yep, awful in Q2, and then by Q3 I'd sort of got myself sorted out and had an okay Q3 and a great Q4, and then the next 2 years were great. But Q2 of 22 was very painful, and I don't intend to make that mistake again. So the way I look at it is, if I sell here in anticipation of a further sell-off, and I'm wrong because it keeps moving up, well, that's okay. That's a high-quality problem. I can just add on the way up, use an actually trailing or a manual stop on the way up, and I can hedge whenever it rolls over. But if it moved up to here and I declared yippee and did nothing, and then it dumped down here, then I would have a hard time looking myself in the eye. So that's my view, and of course everybody's different, but that's sort of my plan. So I think at some point we'll get a relief rally. It might be tomorrow, from here. It might be in a week from here. It might be in 3 months from here. I don't know, but at some point we'll see a relief rally, and that would be my plan personally, which is just lighten up and take some gains, and then see what happens.
Last question on this
Yeah.
is, and certainly tell me if you can get into this detail, but digging into when you see that B wave top, or is it a B wave or is it something else? How
I,
can we how can we gauge and understand, like, when we're reading I don't know, reading the tape, how do we tell
yeah.
this is losing steam, it's selling off, or this is actually
Yeah.
pushing higher? What kind of
Yeah.
things are you looking for?
So Fred Frog is much better than me at the detail of these corrections, much better. And so, he posts pretty frequently, and I would look to his work in Slack on this, and he'll give you much more detail about the nature of a B wave top than I will. So for the more detailed technical analysis, I would look at that. For me personally, I wouldn't so much look for, and again, this is just me. Um, in general, I scare easily, and so I wouldn't be looking for sort of final confirmation of this. I would just say, well, look, it's hit the zero point 0.5 retrace. I think I'll sell some. If it gets the 61.8 retrace, I think I'll sell some more. If it starts to roll over at that point, I'll put a partial hedge on, a quarter or a 50% hedge, and see what happens. And so that's me. I not great at selling at the top or like that. I tend to sell a bit too early in general. I can live with that. So I personally wouldn't be looking for detailed technical confirmation. Look at Fred's stuff on that. He's really, really good. I also don't, as you know, use any sort of momentum indicators. I don't find them personally all that helpful. I don't use RSI. I don't use MACD. But there are standard tools you can use, and things will tell. I personally find those just echo price, and I find if you can eyeball price, it's as good, to be honest. But other people will have a different view on that. So that's my take. But for technical, how do I spot what a B wave top looks like? Ask Fred. He'll have a good answer to that.
Thank you.
Great questions. Thank you. Paloma, you're on.
Alex?
Yeah. Hey.
Hi. Is it my turn or not?
It is. Yep. You're on.
Okay, perfect. How are you?
Very good. Thank you. How are you doing?
I'm good. I didn't know that the hour changed in the US, so
Yeah.
it was just a coincidence that I was on the call.
Yeah. Yeah.
Um, because here we're still at the same hour. We don't change till 2 weeks or something.
Yep. Same here.
Okay, so Wolf, Black Monday again.
Yeah.
This time I'm not gonna call the dip, I think. Unfortunately, I'm trapped also. Long queues, long socks, and pretty scared. Now, for me, the issue is one of the questions I was going to ask you, which you've already practically responded, is what would be the catalyst for this reversal?
Yeah.
So if we have the CPI coming in on Wednesday, we can look at that. I think it's not going to be inflationary because, I mean, oil has been coming down and down and down. So that could be
Right.
a good number for the
Right.
markets.
Right.
And then we have the March expiry, which is the third Friday, but then we won't see that effect till the 24th of Monday.
I don't know about that. I tell you why I don't know about that, because what I find with all of this stuff, technical stuff of all kinds, is because of the internet, more and more people are becoming aware of various institutional tactics. Okay, so I don't think it's a coincidence, for instance, that some of these wave threes are terminating below where they should, in inverted commas. Okay, and I think because the internet is full of people posting Elliott wave charts. Obviously, if you could, you're going to call a stop to a wave three a bit below the 1.618. And I think that OPEX is an increasingly well understood thing. And so if you look at OPEX impact on prices, yeah, in theory, you shouldn't really see an impact until the day after expiry, when the rehedging flows should, in inverted commas, take place. But in practice, increasingly you see OPEX days being less dramatic and the flows taking place the day before, the day itself, the day after. And so I'm not sure we'll have to wait to the 24th. I think we might see, if there's going to be a reversal, I think we might see it on the 20th, 21st itself. So I don't know that it's until the 24th. I think you might see it before then. And then that's because, again, I think market makers are wise to the fact that you've had people like, SpotGamma run all around the internet teaching people about OPEX, and now people are ready for it. So, of course, what are you going to do if you're market maker? You're going to pull the rug on people who are planning to trade OPEX, right? So you may see any reversal that happens maybe a day or two earlier.
Okay, yeah, because I was looking at the calendar and obviously it's Friday, so I was thinking if the effect would be on the next Monday, but with what you're saying, it could start happening the day before.
It can do, yeah, it can do. If you talk to Jay about that, he'll tell you that that you can often see the rehedging flows, a day or two before you would expect them. And I think it's to spread out the impact. I think it's to not give people any sort of V-shaped, bounce or sell-off that they might have been planning on. I think that's why it is.
Okay, and we also have the Fed, so it's a pretty heavy week. I don't think the Fed is.
I mean, again, you don't hear any narrative from Powell that says that there's anything to do with pushing stock prices up. So there's a sort of a meme doing the rounds that goes, percent wants stocks down, Powell wants stocks down, and Trump wants stocks down. And guess what? Stocks are down. The administration is telling everybody that will listen that their focus is on the 10-year, and they want bonds going up and yields going down, and that's what's happening. So I think it's just a question of try and see what's in front of us rather than what we would want. Now, what will kill bonds is some big inflationary print, and we might get that, but as you say, I'm not sure what would cause that. The other thing that's on my mind is liquidity, which is, I'm not sure how this shakes out, but in general, to state the obvious, the private sector surplus. There's a great webinar that Alan Langbond did here a couple of weeks ago. It's in the webinar list if you missed it. In general, running a government is not like running a company. It's nothing like running a company because you control the money supply, particularly if you're the US, and you control the price of money and the availability of money. You can create money when you need it and remove money when you don't need it. And so you have this phenomenon where, at least to some level, federal government spending is great for risk assets. It's great for equities. You've got this whole narrative about, the debt load is bad for equities. Well, it clearly isn't, is it? Because the debt load is, going up all the time, and so are equities. Because when the federal government creates money and injects it into the economy by way of either, paying people or providing social security benefits or, stimulus checks or infrastructure projects or, buying defense equipment, whatever it might be, when the government creates this thing called money and throws it into the economy through various routes, it ends up as a surplus in rich people's pockets. What do rich people do? They spend it on securities. So anyone on this call, has money to spend on securities. That probably means everyone on this call has, enough money for food, shelter, transport, and medicine and all of that. And so spare money goes into investments. And that's where federal liquidity ends up. It ends up in investments, bonds and equities. So I'm not sure how this shakes out because all the logic I just went through about restructuring and refinancing of the federal government in order to benefit bond yields is true, but it's also the case that if you remove Social Security and other benefits, if you remove X of headcount from the federal payroll, and if you cut back on overseas aid, overseas military support, which as I think most people know, you're not posting money to the country for the most part. Mostly you're buying US-made defense equipment to send to the country. That's a lot of federal liquidity that's being withdrawn from the market. And so that, I think, is not a positive for equities. And again, I think it's another story that tells you that bonds are a better story than stocks right now. Now, again, this is all a narrative I'm sort of making up as I go along. But, the administration is saying bonds, not stocks. And all their actions support bonds, not stocks. Because, a big round of layoffs, a reduction in benefits and a reduction in defense spending is a withdrawal of liquidity by any other name. It's a bit like QT. It's a different kind of QT. So that's not a bullish thing for equities. So again, that points to me that if we see a reversal around Q1 OPEX, anything like that, I don't believe it's a sustainable reversal until at least these things are up and over the 200 and holding the 200 as support. And then we can talk about it. Then they have to get up and through the 50-day and turn that into support. And until then, I'm just looking at layers of resistance because, again, that's what the federal government is telling you they want to do. So I have no reason to suppose they're going to act other than in accord with what they say they're going to do. So far, this administration has been, certainly different to past administrations, but it has done exactly what it said it was going to do. You like it, you dislike it, doesn't matter, but it has done what it said it was going to do. So I think that's probably going to be true for bonds and equities as well, my view.
For the US dollar, I should ask Min, right?
Yeah, I don't have a view. I mean, I think in general, a weak dollar probably is good news for this administration, but yeah, talk to Min. It's beyond my pay grade.
Okay, no, yeah, because obviously all these investments are in dollars and not in euros.
Yeah. Same for me. Same for me. Okay.
Super.
Thanks, Paloma. Great questions as always. Thank you. Richard, you're on.
Thanks, Alex. I was going to make a comment more than a question, and just in terms of scratching my head as to why the administration would want to jeopardize the engine of growth and create so much uncertainty, because whilst we understand they want to bring the yield down, surely reduced economic activity, more unemployment, layoffs, potential for the R word and all the rest of it means less income coming in. So just kind of really making a comment as to why or can't really understand why they would think that takes precedence over keeping the economy humming and therefore revenues coming in. On the Slack chat.
Yeah, me neither.
Morgan just posted a chart.
Yeah, me neither. But I mean, my view is, who knows why anyone does anything? I don't know why they think that's a good policy, and it'll turn out to be a good policy or it won't. I don't know. But my frame of reference here is, okay, what things are going to go up and what securities are going to go up and what securities are going to go down. And again, they're doing what they said they were going to do. And so far, bonds are going up and stocks are going down. So I agree with you. I don't know why they think that's a good thing to do, but they clearly do. And they'll be right or they're wrong. I don't know. But I don't know why they think it's a good idea.
Yeah, I was just going to point to the chart that Omerdin Ekim put on Slack, which shows debt maturity. So that's
very
coincidence in inverted commas. So so we'll just see, as you said. The other question I just wanted to ask, you've seen or you've shown two potential A equals C corrections that theoretically may have just completed for the IWM and DIA, but we should therefore expect to see a rise, from both of those. And so just trying to square that circle in terms of, okay, how does that work if, we're in this kind of negative correction and yet we've seen an A equals C on both of those?
Yeah, I think it's possible. And the reason I think it's possible is that these two, you can see the Russell is absolutely beaten up, right? It's in terrible shape. It's back to August. It's almost back at the Yen-Mageddon low. It's dreadful. So it was the first one to tumble. I think the Dow probably rolled over. Dow rolled over a bit later, I think. December, was it? Yeah, Dow a couple of weeks later. And, that is a righteous that is a righteous correction. And so just from that alone, you'd say there's a chance of a rebound in the Russell. And if the Russell's moving up, I mean, if people are prepared to risk capital on the Russell, then surely they'll risk it on the S&P. As you know, another common correction is, C equals 1.618A. I won't try and work it out in my head, but I mean, that would put the correction down to 180 or something. Again, I'm just guessing, but there and thereabouts. So it's possible we see a much deeper correction, but this is the first place at which I think it's possible that we see a turn up in the two indices that tend to lead. And if you look, this is just a copy paste of the A drop. It's to the cent almost. Look, that's where today's low was. It's actually to the cent. It's remarkable. So there's no way that's not algorithmically driven. Absolutely not a chance that's a coincidence. No way. And so somebody at least has said, okay, we'll start buying at the A equals C low, and start buying in some volume. So we'll see. And the Dow, same story. It dropped very slightly below an A equals C. It's a bit more of a weird correction because the B nearly made a new high. But again, this is sort of the first place you would expect the Dow or the Russell to turn up. And if they turn up, they often lead the way out of a correction. So yeah, I can't really square the circle between the NASDAQ looks like it's got further to go, blah, 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 blah. All I can say is if we get a turn up, it might happen in the Russell and the Dow first. And why I think it might only be a relief rally is because this NASDAQ correction doesn't look complete to me. So I think how might that work? I mean, it could be that you get a rotation from the NASDAQ to the Dow. I never really believe that happens on any sustainable way, to be honest. But let's say we do. There's a really, really good note that Sam sent to me today. I'll leave it to him to see if he can actually share it or not, whether he's able to do so. But it was basically a thesis that said, look, a lot of the thinking of the current administration is much more to do with, the US as a nation state rather than the US as sort of the backbone of the global economy. Now, to the extent that is true, and obviously I don't know if it's true or not, but if it is true, that probably favors the Dow over the NASDAQ, probably, because to generalize very broadly, the Dow has more companies in it which have a greater percentage of revenue and economic activity in the US than does the NASDAQ, which, as you know, tends to be more global. So maybe this sees a rotation from the NASDAQ to the Dow. I'm quite sure I believe in that. But what I do think is okay, that Russell looks like it's the first place you might find a bounce. The Dow, first place you might find a bounce. If they go up, probably the NASDAQ will go up. But because the NASDAQ isn't complete as a correction, I think it's a relief rally. And again, this all could be wrong. My change in tone from last week is a simple artifact, which is we're below the 200-day. That's it. On the NASDAQ and the S&P and the Dow and the Russell, we're below the 200-day. So one ought to be, by default, more bearish at this point. And one ought to look at recapturing the 200-day and then the 50-day as real hurdles to cross. So if it does that, then we should all feel bullish again. We have to obviously go by what's in front of us.
Thanks, Alex.
Sorry, long question, long answer rather. I've got two written questions. We're not going to get to single name stocks, but I mean, my simple view is below the 200-day at risk, above the 200-day opportunity until the 50-day. See if it passes the 50-day or whether it hits the 50-day and turns it into resistance. Okay, I have a question from Mark by way of Ryan. Thanks. Okay, longer term implications for TLT reduction. Yeah, exactly. I mean, so Mark asks, if there is a reduction in international demand for US debt, is that a good story for TLT? And the answer is clearly no. So if we're to get anything other than a short-term rise in TLT, then you have to have sustained buying of US government bonds. Now, what will help that? Well, a weak dollar will help that because it makes them cheaper in relative to other currencies. What else will help that? The US economy continuing to be stronger than other economies. There's a political aspect to it as well, I suspect, which is you'd have to think about, well, which countries politically want to own lots of US debt and why. So that would be a question of, the shape-shifting form of foreign policy right now. So you have to think about that. So I don't know how it shakes out, but I do know that you're right, Mark, which is if there is a reduction in international demand for US debt, then not good for TLT. If the world continues to get more atavistic, then what would you expect? You'd expect a capital flight to safety. Historically, the safest thing has been US government bonds, and if things continue to turn uglier over time, then naturally you would think that US government bonds would be a good place to be. What's your alternative if you are a custodian of large amounts of capital? Well, you've got national bonds of various kinds, but as of yet you don't have pan-European EU bonds backed by all the sovereign EU states. They don't exist yet. Chinese government bonds probably not as solid. So I think for now, still, US government debt is probably still the safest port in a storm for most, and any weakening in the US dollar will only add to that argument. So I don't know how it shakes out, but yes, obviously you need international buyers to keep this thing moving up. Yeah, it's a good point. Thank you. I've got time for one last question, I think. Hang on, there was one written one. Bear with me a second. Oh yeah, I've got two people asking for SOXX. So we're going to do SOXX, then we're going to finish up. Yeah, it's a mess. Look, it's back to the Yen-Mageddon lows. Bounce just over it. So that's not a 1 and a 2. Right, we can forget that. That's broken. That's not, that's not a retrace. Let's zoom out a bit. So let's see what we have. Let's go back to, first of all, let's look at some volume. Right, so let's go back to the lows. Okay, so let's redraw this. Okay, so let's take a bearish view first. And let's say that that's a wave 3. Let's say that's a wave 4. And let's say that's wave 5. Okay, so let's take a bearish view. Let's say that's a 5-wave run up from the October 22 lows to the July 24 highs. And let's say that the Yen-Mageddon and then DeepSeek and whatnot, let's say we're just trending sideways. So I think the question you have to ask is, what is this? Is this distribution? Okay, it could be. It's a funny kind of correction, this. If that's a wave 5 high, this is a funny kind of correction. Why? Because it's being held in this range now for, 9 months. So it could be that this is distribution of all the stock that was bought, down here and here. Could be. In which case, what would you expect to see? And things don't always have to correct in an ABC, but it's not a bad sort of proxy. And let's see if it put in A equals C. So you could see it correct down to 166, maybe from 194. That'd be I mean, you can always be more bearish, of course you can, but that would be a sort of a modestly bearish thing to happen. But alternatively, you could say, well, if we zoom out on SOXX, you could most certainly say that if you zoom out and go back to the COVID lows, that is just a very shallow wave 3 high. It just is. And either this whole thing here is a wave 4 with a kind of correction, which again, ask Fred what he would call that. I think he might call that a running flat. I'm not sure. And you might say, well, this is hovering over the wave 1 high put in January 22, 185. And you've seen me say in the notes over 186, but still bullish. And we're about to turn into wave 5 high. That definitely could be true. I don't know. I would think that you would have to use this wave 1 high here as a test level of sorts. And I think you would have to say that, and I've said it in the notes a couple of times, below 185, 186, 185, you got to worry. Over this level, no reason why that's not a shallow wave 3 and a wave 4 correction, or frankly, even that isn't a complete wave 3. We could run up here, but there's just a setback beforehand. Very difficult to say. For all of us, the news flow is relentless at the moment, and so it's hard, really difficult to feel balanced and calm about investing and trading. Because there's just a torrent of unusually volatile news. And the price action is volatile, so it's really easy to get swept up in the everything's going to zero, and that we might be in the middle of at the early stage of a really deep bear market, but that's not definitely the case. And SOXX does not yet say bear market. It might well say that was a shallow wave 3. That's the sort of getting towards as much of a wave 4 correction as you could find, and then a wave 5 higher. It could even say that this is just a pullback in the middle of a wave 3 that is yet to complete. And certainly everything in semiconductor fundamentals looks good. You look at Broadcom's numbers printed last week, we put a note out, pretty good. Taiwan Semiconductor printed their monthly earnings, not quarterly, but monthly revenue today. I put a note in the Slack, they were up, I'm going to say 40-something%, which is above recent trend. So everything in semiconductor fundamentals looks good, looks really good. So there's no, definite reason why one has to be bearish on stocks. I think you have to be alive to two things. You have to look at the key tests all the way along. At the index level, if no reversal around March OPEX, before on or before March OPEX, you have to, I think, favor the bearish perspective. In single name stocks below the 200-day, you have to favor the bearish. Above the 200-day, you favor the bullish until it hits the 50. And if it hits the 50, turns into resistance and sells off again, you have to favor the bearish once more. Then you'll see a retest of the 200, and that behavior at the retest is critical. That's single name stocks and probably sector ETFs as well. So I think all one has to do is just be aware of both paths, and don't sleep on bonds, and don't sleep on cash positions, and don't be afraid to hedge at low levels. I wouldn't aggressively hedge personally here because you might get a bounce, but partial hedges are okay. Selling some positions to release a bit of cash, I think that's okay too. You see me do that on the way down, that's fine too. Key is, as always, you have to keep your head on straight, calm, ignore the news flow, watch what price is doing. Doesn't matter who's tweeting what, doesn't matter who's saying what on CNBC. That's all irrelevant. Just got to watch the price. Okay, we're well over time, so thank you everyone for today. Great questions. It's obviously a tough time in the market, but as I always say, we have all the tools and the analysis in this service here, and a collection of fantastically bright investors and traders in the community here, for which I'm eternally grateful that you're all members. And we have all the methods we need here to make money, good market or bad. If one misses selling at the top, well, that's okay. No one sells perfectly at the top. All you have to do is, behave rationally at the next juncture. So there's a good adage somewhere which says, the best time to do anything was 20 years ago, and the next best time is, today. So no one ever calls tops and bottoms perfectly. All you can do is course correct along the way. So if, for instance, you decide market's going to dump tomorrow, I'm going to take out full hedges, and then it rockets up tomorrow, well, you just have to reverse position. If you think it's definitely going to get a bounce here, I'm not hedging, and it sells off again tomorrow, well, you've probably got to reconsider and add some hedges or raise some cash. You just have to stay alive to how the market reacts, and the market in front of us, not the market on our heads. Okay, folks, we're well over time. Thanks again, everyone. I'll post the recording in a couple of hours once it's in HD, and speak to you all in chat later on. Thanks, everyone.